Silicon Valley Bank, SVB, has been a stalwart of the tech industry for decades, but in March 2023, the bank suffered a sudden and catastrophic collapse. What led to the downfall of this iconic financial institution? 1. SVB's rise to prominence. SVB was founded in 1983 in Santa Clara, California, by entrepreneurs who recognized the need for a bank that could meet the unique needs of the tech industry. The bank quickly gained a reputation for providing innovative financial solutions to startups and venture capitalists, and it grew rapidly along with the tech sector. 2. The warning signs. Despite SVB's early success, there were signs of trouble ahead. The bank's loan portfolio was heavily concentrated in the tech sector, and it had taken on significant risk by lending to high-growth startups that had yet to turn a profit. Additionally, SVB had become increasingly reliant on short-term funding, which made it vulnerable to market volatility. 3. The collapse. In March 2023, SVB was hit by a perfect storm of factors that led to its collapse. A sudden downturn in the tech sector caused many of the bank's loans to default, while a run on short-term funding sources left SVB unable to meet its obligations. Panic set in among SVB's clients, who withdrew their deposits en masse, exacerbating the bank's liquidity crisis. Within days, SVB was forced to declare bankruptcy. 4. The fallout. SVB's collapse sent shockwaves throughout the tech industry, which had relied on the bank for financing and other services. Many startups were left without access to capital, and investors lost millions of dollars in deposits. The broader financial system also felt the effects of SVB's collapse, as other banks and investors scrambled to mitigate their exposure to the troubled institution. 5. Lessons learned. SVB's collapse serves as a cautionary tale for the tech industry and the broader financial sector. It highlights the dangers of excessive risk-taking and over-reliance on short-term funding, as well as the need for banks to maintain diversified loan portfolios. The collapse also underscores the importance of strong regulatory oversight to prevent systemic risks from emerging in the financial system. 6. Regulatory response. In the wake of SVB's collapse, regulators moved swiftly to prevent a wider financial crisis. The Federal Reserve injected liquidity into the system to calm markets, while the Securities and Exchange Commission launched an investigation into SVB's practices leading up to the collapse. The Dodd-Frank Wall Street Reform and Consumer Protection Act was also amended to strengthen regulations on banks' exposure to the tech sector. 7. Recovery efforts. In the months following SVB's collapse, efforts were made to stabilize the tech sector and support affected startups. Venture capitalists stepped in to provide funding to promising companies, while alternative financing platforms emerged to fill the void left by SVB. The collapse also prompted a broader rethinking of the tech industry's growth at all costs mentality, with a renewed focus on sustainable business models and profitability. 8. The future of banking. SVB's collapse may have been a painful wake-up call for the tech industry and the financial sector, but it also presents an opportunity for innovation and reform. As the economy continues to evolve, banks must adapt to meet the changing needs of businesses and consumers. This may involve new forms of financing, more robust risk management practices, and a greater focus on sustainability and social responsibility. 9. Impact on the tech industry. SVB's collapse has had a profound impact on the tech industry, which is still grappling with the fallout. Many startups have had to pivot their business models or seek funding from alternative sources, while investors have become more cautious. 10. The road ahead. In the aftermath of SVB's collapse, the road ahead remains uncertain for both the tech industry and the financial sector. While some see the collapse as a sign of systemic risk in the tech sector, others view it as an isolated incident that does not reflect broader trends. Nevertheless, the collapse has underscored the need for greater transparency, accountability, and responsible practices in both the tech and finance industries. As banks and startups alike navigate the post-SVB landscape, they will need to prioritize risk management, liquidity, and long-term sustainability in their business models. This may require more collaboration between the tech and finance sectors, as well as greater regulatory oversight to ensure that systemic risks are minimized. Ultimately, the lessons learned from SVB's collapse may pave the way for a more stable, resilient, and equitable financial system.